Welcome everyone to the Thursday Elite Zoom training. Today I had a special request from one of our agents to do an illustration. It's a more of a custom IUL type of client. So what I'm gonna do is I'm gonna show you an illustration today through F&G IUL and how to structure it and so, if it's okay, Jory, maybe you can kind of give the background of like the client, what he was looking for, and then what we can do is we can go into kind of designing it to what the client is looking for. Can you just share a little bit about what you shared with me, um, what he was looking for?
Yeah, absolutely. So he's already got like retirement and stuff set up. So he's got a pretty specific plan. He wants to get 50 to $75,000 saved up within like 10 years. Um, but he also wants some extra life insurance because he has mortgage protection, but he has other assets that he needs to protect. But he also wants to make sure that his family's got income if he passes away. So she doesn't have to necessarily go back to work right away.
Yeah, yeah, thanks, Jory. So that is, yeah, so this is a client who makes a decent amount of money, like $200,000 a year plus. And he's comfortable and he's also doing his own retirement things with his 401k. Now, he was originally looking for mortgage protection on this. So he wanted to protect his family in case something happens to him. But at the same time, he also wants to accumulate cash value so that later, if he wants to like build a barn or if you want to use the money to pay down his home fast so that he can pay off the home early, that's kind of the scenario of this particular client. So let me go ahead and share my screen. When it comes to the IULs and whole life, they agents ask me, so what is better? Like, is IUL better or is whole life better? Right? But the biggest difference between the whole life and IUL is that the whole life is a great program if a client is wanting to use the money, the cash value, pretty soon after they start the program. So let's just say if a client says, hey, I have five pieces of debt and I want to keep using the money and pay this debt down over the next 6 months, 12 months, 24 months, then the participating whole life, such as Forrester's Advantage Plus Two or Live Well, which is our instant decision whole life policy that just came out, those will be a great fit because whole life, the way it's designed, they have liquidity, immediate liquidity after 60 days of getting the policy. All right. And when I say 60, it's actually over 30 days, but I just say 60 so that it gives plenty of time for the policy to be set up and everything. So clients are like, oh, why can't I take my money out right away? Anyways, so if a client is looking to use the money right away and use the cash value continuously, more of an infinite banking or paying off their debt, whole life will make more sense. Because after the 60 days, client has access up to 90% of the surrender value. So client can take out the money. So if a client put 20 grand there in a lump sum and they want to take out money, they have more access to the money. Does that make sense? Now, IUL is better, in my opinion, if the client wants to leave the money in there for the next 10 years or more. Okay. If a client is like, hey, I wanna leave the money in here at least for 10 years and I want this to be my retirement income. I want this to be something like a my 401k, my Roth IRA, then IUL to me would be a better fit because they don't have to touch the money early on. They can wait until later and use the money to supplement their income or pay down their mortgage or whatever. So in this particular scenario, client said that he would like to accumulate about 50 to $75,000 over the next 10 years, right? So he's not trying to touch the money in the next couple years. So that's why I feel like in this scenario, IUL would be a better fit. Okay? That's my thought process. So we're gonna go ahead and log into the F&G website. Okay. So under the sales tools, you go to illustrations and F&G Life Illustration Explorer. And this client, just so you know, client is born in 87. So I think the client is like what, 38, 37, turning 38 in November. So 37 currently. One thing that is advantageous for us in this scenario is his age is still pretty young, that it gives us plenty of time for him to grow this money and potentially pay this his home off early in the future too. So we're gonna go to start new case. Okay. And we're gonna just go ahead and do the illustrations. Name Daniel Smith. All right. And the birthday doesn't really matter, but we can make him 37, male. And what we do is we're gonna go ahead and he's in Connecticut. Let's go to Connecticut. Oh, didn't press. Okay. And then Index Universal Life. Let's see. There you go. Find available products. And the F&G Pathsetter, you're going to click select. And the client is in pretty good health, but I usually apply for standard non-tobacco or standard tobacco if the client is a smoker. And the reason why I don't do the preferred non-tobacco is because even if the client's health is good, in case something was in their record and they came back standard, then sometimes the cost of insurance inside of the IUL is higher and they might have to pay more premium. I'd rather do an illustration standard, but if the client comes back preferred because they had better health than what we expected, then they'll automatically upgrade the client to a preferred rating. So client is not missing out, okay? And at that point, you can always go back and give them a better news. Hey, by the way, we applied for standard, but you got preferred. You have a great health. Congratulations. That means more money in your IUL is going to go towards the cash value than the cost of insurance. Okay, so standard non-tobacco and solve for, this is where I would go ahead and try something. First of all, you can go ahead and do the max accumulation. The max accumulation one, you can click on the specified premium, the three dots. You can click on one of the monthly premiums. And I just wanted to do an example with what would $1,000 give the client. So let's go ahead and put $1,000 a month. Okay. And you scroll down and you click OK. And what I wanted to do is I was thinking maybe don't have the client pay to age 100 or year 100. What I was thinking is since the client wants to use the money pretty early on, maybe I could do it to where client stops paying into it around age 65. All right. So A means age, 65 is the number of age. So age 65. And I click OK. And you scroll down, you don't have to really do anything here because it's going to automatically calculate what the $1,000 a month will give him in terms of death benefit for a max accumulation solve. So we're going to leave it at option A for now because option A is the base. And then you scroll down to the investment options and to the right, the illustration rate. This is the average of how this particular index has performed, and they give an illustration rate. So sometimes it actually has done better than this, but they have to be a little bit conservative because market could not be as good as the last 20 years. So these are pretty conservative in a way. But if you take a look at the both of the Morgan Stanleys, it says Morgan Stanley US Equity Allocator. One says with bonus and 90% participation. The other one says Morgan Stanley US Equity Allocator, but it says 110% participation, but it doesn't have a bonus. This one, if you take a look at it, it has performed better over the last 20 years. So I'm not going to put it into this one. I zero that out and I put 50 here. BlackRock, there's 50% in that, but BlackRock has not been performing as well in terms of the illustration rate, but S&P has been doing pretty well, above 7 over the last 20 plus years. So I'm going to go ahead and put 50 here and take out the BlackRock. And client can diversify if they wanted to, like 25, 25, 25, 25, 70, 30. You can do that. And client can change the allocation once a year on their anniversary. Okay. So we're going to go ahead and do the S&P 500, 100% participation, which is the kind of like the gold standard for investment. A lot of the 401ks are based on that. And then the Morgan Stanley US Equity Allocator has been performing really well, uh, almost outperforming the S&P when it comes to our index. So I'm going to show you that. That's it. And then what you do is you go up here and click View and Print Illustration. So right now it's generating an illustration based on a 37-year-old male. If he wanted to put in $1,000 a month, what would the face amount and death benefit come out? And how much cash value would the client have in the next 5, 10, 20, 30 years? That's my calculation on this, okay? So one thing though, Jory, in this situation, do you see the face amount is over 1 million? So once it's over 1 million, Pathsetter can go fully underwritten. So we don't want that, okay? I don't want to have it more than 1 million. So what
Okay.
I can do is I can exit out of this. I can exit out of this because I don't want the client to have to do a fully underwritten. Client is young and healthy. So I'm going to go out. And when it gets back to the illustration page, I'm going to take off the max accumulation and I'm going to make it none so I can choose the face amount. So I'm going to choose a face amount of $1 million. And then I'm going to have the premium type to make sure it's still $1,000. So I'm forcing the illustration to give me a death benefit of 1 million and the premium to be $1,000 a month.
So it's after 1 million, not 1 million.
Up to 1 million is non-med.
It's
But if it's
not.
one
Okay.
million and $1, then it can become a fully underwritten product.
Okay. All right. Thank you.
Yeah, you're welcome. The exciting thing about the F&G is that they're going to be rolling out a brand new product at the conference. And that's why also another reason why I told everyone you have to come to the conference. We're going to be rolling out an industry first. Symmetry, Quility, and F&G together developed a new product called F&G Quantum, which is a brand new IUL, up to $2 million instant decision IUL that they're coming out with. Huge. It's going to be a game changer. But let's go ahead and review this real quick. I'm going to save this. So let's go ahead and take a look at, yeah, this one. All right. So this is saved now. When you scroll down to the first page, now I forced it, right? $1 million face amount and $1,000 monthly premium. I kind of like designed it this way, right? Because of what the client was looking for. So as I scroll down, I want to go to the tabular detail. So, Jory, if the client keeps putting money into this, by the time he's 10 years in, how much does he have?
Looks like 103, almost
About
104,000.
yeah, right. So that's actually, but even if you look at the surrender value, it's almost 100. So
Yeah.
that's actually more than what the client has been looking for. But the selling point on this story would be you said that you want to potentially buy a barn in the next 10 years for 50 to 75 grand, depending on the market and the inflation.
Yeah.
But on top of that, he wanted to really pay off the home as early as possible, right?
Yeah.
So on top of paying off the barn, he can also use the money to pay down his mortgage if they wanted to. So this could be kind of that one program that gives him a protection that he's looking for his mortgage protection and potential income replacement if he passes away. But also, if those things don't happen, the client has the ability to use the money tax-free in the later years. So what does this mean? Instead of him waiting for to pay for that barn in 10 years, maybe he can purchase it in 6 to 8 years because he has enough money in there to buy that.
Okay.
So that could also shorten his timeline of what he wants to purchase. So
Right.
if we were to use this method, you can now go back and maybe client said this is too much, then maybe you can go back and do like a $700 a month coverage for $700,000 in coverage for 700 a month. So that way you can do another illustration to show them a little less monthly premium. Okay.
Okay. So I would match the death benefit with the face amount.
In this case, I'm just doing it for a couple of reasons. You saw that when I originally did the illustration for max accumulation, what was the face amount?
It was over a million by like,
1.08, right?
yeah.
1.08 million.
Yeah.
So I don't want the client to have to do blood work. So what I did was I set the face amount to be forced to be $1 million, not any more than that. And
Right.
I kept the same $1,000 premium. But this doesn't work for everyone. In this scenario, it worked. Some clients who are older, maybe $1,000 a month only gives them 600,000 or 500,000 or $300,000 coverage. So it's all based on the client's age and gender and their health.
Okay. So if he came, because we did this as standard, right? So if
Yeah.
we left it in accumulation and it said, let's say 999,000, but then he
Mhm.
came back as preferred, would that face death benefit face amount be increased?
That's a great question, Dory. Now, it could if you let it, but you can also you can let the underwriter know that, hey, the client doesn't want extra death benefit. They want to keep the death benefit the same. They just want to keep the premium the same, and they also want to keep the death benefit the same. Then what that means is more money out of what they pay monthly goes to the cash value. So the
Okay.
death benefit doesn't have to increase just because the client got a preferred rating.
All right. Thank you.
Yeah. Okay. So this will be a great example of what you could offer to your client. And on top of this, what's great about this, Dory, is that client is only 37 years old. So even if he works for the next 20 years, he'll be still 57. So look at the age of 57. He'll have around 341,000 if he didn't touch any money, right? If he by the time he's 67, I mean, he has almost $800,000 in there. So this is something that a client can utilize as a protection plan, but also something that accumulates tax-free wealth on top of that. Okay.
It looks pretty good.
Yeah. So I would say this is a really good one. But also I'm gonna show you a little different one as well, in case you wanted to show the client a little different scenario. So I'm just gonna put Daniel Smith on this one. F&G Pathsetter 1 million. And the reason why I'm so specific naming the file is because I might be doing extra illustrations, and that way I know which illustration is which when I'm looking for it. And if you were to go down, I'm gonna show you something all the way down to page 21. There's a page on the bottom. It tells you different amounts that the client can put in this scenario. Okay. So take a look at this. If you look at it, what is the target premium? 11,980.
Yeah.
So almost all of the monthly payment is target, right? So Jory, if you were to offer this to the client and client gets it, then your APV that you're gonna get paid on based on is 11,980, almost the entire thing, right?
Oh, that's pretty nice.
Yeah, this is a big policy, right?
Yeah.
Seven pay is the MEC, modified endowment contract. So that means if the client wants to pay the maximum amount of money for the next 7 years, what is the most money they can put a year? Is $63,720 a year for the next 7 years.
Okay.
Can I ask a
That,
question on that, Sean?
yeah, go ahead.
So once they do that, like let's just say they wanted to max fund this at that 7 pay and put that
Yeah,
63,000. So if they do it for 7 years, then they can never contribute to the account again after that.
correct. Yeah, if they were to pay the full 7 year max pay, yeah, they can't put any more than that.
And if they borrow from it, can they then start contributing to it again because they're repaying?
Yeah, if it's a repayment back as a loan, repayment towards a loan that you borrowed against, then yeah, you can put back in, but it won't be something that you can pay extra on top of what they have put in over the next 7 years if they maxed it out.
Okay. So, and I'm sorry, but just one more quick question
Yeah,
because I've been trying to figure this out and maybe you were
yeah,
going to answer that. But so let's just say somebody came to me and they said, "Listen, I have $20,000 a year I want to
uh-huh,
throw into this. I want to keep my insurance costs as low as possible. What, like, how would I structure that for a lump sum on a yearly basis? Because I feel like if you put that 20,000 as an annual premium
hmm
when you're doing an illustration, it
yeah,
kicks you out this enormous amount of insurance.
yeah.
But if you just put in a less amount and then tell them that they can contribute, they can max fund it up to that 7 pay, it's less
Mm.
insurance. Does that make sense what I'm asking?
Um, a little bit. Can you say it one more time?
So if I just went in and did an illustration and somebody said, I want to put in $20,000 a year
Yeah.
for the next 7 years, and I
Mhm.
went in and basically illustrated that in that details page and put in 20,000 annually
Yeah.
and max funded that, when that illustration prints and you come down to this page, there would be a lot more money that they could actually contribute to the account, right? Because it's
hmm
giving them that higher insurance.
Not necessarily.
Not
Yeah,
necessarily.
yeah. So, Kat, yeah, that's a good question. So remember if the client is if we are designing this, the target is gonna be a lot lower if you're to do a 7 pay. So what I mean by that is you see a pretty big gap between what the target premium is and the 7 pay, right?
Mm-hmm.
So if the client is so in this scenario, not the 20,000 example, since we don't
Right.
have the illustration in front of us,
Right.
if we were to use this as an example, 7 pay of 63,720, it's quite a lot more money, but look at the target. So you are as an agent, for example, you're only going to get credit for 11,980 even if the client decided to pay $63,720 a year for the next 7 years. Right? So the face amount still is going to be million. This is just the mech for the $1 million. If we lower this to $500,000 face amount, then also the 7 pay will go down and the as well. So that's kind of so the mech is based on the face amount of what you're getting the client. I don't know if that makes sense.
Yeah, it does. I guess I just didn't know, like, I guess the question I was trying to ask is why wouldn't you go with less insurance and let them just max fund less insurance than to give them more insurance and set it up with a much higher initial target premium, I guess. How does that benefit them? I guess was what I was trying to
So
understand.
like for example, so if a client's IUL is such a flexible plan, it can be used for multiple purposes. So some clients would say, "Hey, I like cash value, but I also really believe in the death benefit and the living benefits." So client wants a still a large amount of death benefit, right? And some clients, they don't care. They want the minimum death benefit and they want the most amount of money put in, right? But also remember, if you minimize the death benefit too much, so let's just say you minimize the death benefit so much, the death benefit was only like 150,000, but client is putting a large amount of money, then that can be great. But also remember the depending on how much you set them up with the death benefit up front, the amount of money that they can put in is limited. So if a client says, "Hey, Sean, I can see myself, I only want to put $1,000 a month right now, but I could see myself putting three, four, $5,000 a month in the future," then you shouldn't make the death benefit so little because what? Because if the ceiling is only 2,000 a month, the client will not able to put three, four, $5,000 down the
Got
road.
it.
So in the
Okay.
beginning, what you set up as a death benefit it kind of dictates how much the money client can put in the future.
Got it. Okay. That
Yeah.
makes sense.
Yeah. So if the client says, "Hey, $1,000 is the absolute most that I'll ever pay. I'm not gonna pay two, three, 4,000," then yes, Kat, you can design a death benefit to be minimum and maximum cash value solve and make the $1,000 the absolute most that the client can pay in. And yes, that could be a really attractive program for the client.
Okay, got it.
Yeah.
Thanks.
Yeah. But a lot of the clients, when you talk to them, they say I want to put 500, but I can see myself putting more. So that's why I leave enough room that the client can put more money in there in the future because you don't know what the future holds. Okay. And in this particular scenario, monthly minimum no lapse is about $500, 499. So that means if the client is paying 1,000, but like a client was in a financial bind and they can't pay the full $1,000, they can pay as little as $499 a month to keep the policy going without lapsing. And that's not forever though. Let me go ahead and show you. If you go to the top, the minimum no lapse, as you can see, it is guaranteed until 52 years old. That's usually 15 years of this policy. So client is 37 and 15 years from now is 52. So in case client cannot pay the $1,000 a month, client can pay as little as 499 a month to keep the policy going and keep the benefits and things like that.
All right. What page is that on?
This page is actually on page, I think this is two. Yeah, this is page two.
Okay.
So this is in the beginning, so you can also show that. So in this scenario, and it's a balance too. So for agents, if you were to be setting this up for a client, but I was talking to one of the agents yesterday, and agent wanted to obviously what's best for the client, but he set it up to where his commission was like $80 for the whole IUL because he minimized the death benefit so much and focusing on the cash value that there was almost nothing. I mean, it was a children's policy to be fair, but I mean, I'm just saying that. So what we want to do is think about a couple of different things. The reason why I don't make the death benefit so low, one reason is I still want the client to have the ability to add more money in there in the future so that they're not limited by the MEC and other things. Number two, agents are not working for free. So if you were to have a target premium so low and you've been working for days, weeks with the clients and you're not going to get paid at all. So when you're doing an IUL sometimes get a bad representation because what agents do is they focus all on the commission by making all about the high death benefit, and so little money goes to the cash value. And the cash value eventually diminishes and they lose the coverage. And that happens out there, guys. So what we want to do as an agent is be professional and understand what the client is looking for, and we design it a great program for them that actually doesn't sacrifice the client's cash value, but also doesn't sacrifice the client's coverage amount. Okay, so it's a balance between the two.
Yeah, I think for him, because he did want additional death benefit, I think that death benefit is also important to him because he did say he wanted another policy because he's afraid if something happens to him that his
Exactly.
family won't be. So
Yeah.
how does the commission work on, is this an 80%? Like if I'm at level 80
No.
or
So that's a good question too. This commission grid can be found on HQ, but I just have it saved in my bookmark. So, uh, for commissions, this is how it works. Symmetry commission level is the commission grid that gets sent out to each carriers, but each carriers have their own payout and commission grid based on each product that they offer. So what I mean by that is if you were to offer a particular product, such as, let's just say, a very popular term is legal in general. Term is 100% cost of insurance. There's no cash value, right? There's no cash value for the client. So all the premium that the client pays is cost of insurance, right? So because of that, they pay out. This is your symmetry commission on the green. So if you're at an 80%, you get paid 80% if you sell a 20 plus year term. If it's a 15 year or a 10 year, then you get 10% less. You see that? But if you were to sell an IUL, a lot of the premium is not just the cost of insurance. Also, it's the cash value for the client, right? So really, the insurance company is not making a lot of money on that cash value portion. It's really for the client's cash value, right? So what they do is they pay out less amount to make sense for their compensation. So if you look at the pass setter between the age of 18 and 80, which is the most common, 80% will pay 55% out, which is, I think, 25% less. And as your commission level goes up to 85, you get 5% more every time. So that's one of the things that I talked about. If you're using mortgage protection leads, I would recommend you to give the client the coverage that they're looking for. And mortgage is a term, and clients are usually looking for an affordable price. So you can give them a term policy first. And then a year from now, when you revisit with them and say, hey, I wanted to do a policy review with you, and at that point, you can go over their term and potentially talk about converting or replacing it with an IUL, cash value, something that it will show for and have cash value in the future. And that way, you earn your business with the client, sell them a term, and then you can always upgrade them later. And that's how you also you can grow your book of business as well and have repeated clients, repeated customers. Okay. So this is how you look at the commission grid, and they break down each and every company. So, like for example, Mutual of Omaha is also very popular, right? So Mutual of Omaha Term Life Express, if you sell a 15, 20, or 30-year term, they pay the full commission. 80 is 80. But if you only sell a 10-year term, the company is not having the pay of the premium as long as the 15, 20, and 30. So they're paying 60%. So it's 20% less. If you take a look at the Index Universal Life, MU IULE, it pays 55, which is pretty much the same as Fidelity and Guarantee. So across the board, insurance companies tend to pay less for IULs and whole life because it is a less profitable product for the insurance companies. I hope that makes sense, Jordan. Okay.
Yeah, that makes sense.
Yeah.
Thank
So
you.
yeah, you're welcome. Going back to the illustration, I wanted to let me see. Okay, they want me to log in again. And the last thing I wanted to show you is in case client wanted to have the death benefit go up in the future, then you can also set it up that way. So what I mean by that is I made it level because client can have a level death benefit and later turn it on to have an increasing death benefit as well, or vice versa. They can turn off the death benefit from going up anymore. So you can choose something called option B. Option B means the death benefit goes up as the cash value grows. So if you look at the third option, it says option B to A. This means the death benefit goes up, and at a certain age, you're stopping the death benefit from going up and level. So it goes up but stops growing. So let's just say we put that at the age of 70. Age 70, we're going to stop the death benefit from growing. And let's do the illustration. So Nothing else should have changed. The death benefit should be 1 million, the premium should be 1,000, but only th difference is that we're increasing the death benefit year by year, little by little. And I want to show you how it's different for the clients. Here we go. So if you take a look at it, so do you remember the other one that I showed you? Do you remember on this one, the original one that we did for 1 million, option A?
Yeah.
Client will have in 20 years, we'll have 341,000 and the at 67 client will have around 798,000, right?
Yeah.
But the death benefit was $1 million. If you look at this one, the cash value is a little less, right?
Yeah.
Why?
Does the death benefit went
Because the
up?
death benefit is option B, so the death benefit is going up a little by little. So the cost of insurance is higher over time. So this is why the client's death benefit is now 1.7 million. So they have a higher death benefit, and if the client takes out the money, then the death benefit will be reduced for that amount. So this is also great, but it depends on what the client is looking for. If the client says, "Hey, I want the most amount available later," then this 735 versus this 798, this has more money for the client, right? But if the client wants to have still significant death benefit after taking out the money, then this can also make sense. Have a little bit of less cash value, but also have a bigger death benefit and living benefits for the family. So you
Okay.
Hey,
can
Sean, I
design
have
it
a quick
differently.
question on that.
Go ahead.
Would you ever, in reality, though, stop them contributing at age 65, but have the policy premiums can or the death benefit continue to rise to age 70? Wouldn't that really affect cash?
No, actually, not too much. And the reason why I did it this way, Kat, is if I were to make the death benefit to stop growing at 65, I would say it's kind of limiting the client's death benefit from growing. So if a client's death benefit is not really as of a concern, then I will do option A. But if the client is looking for a higher death benefit over time, I just wanted to have it grow a little longer so that they have a higher death benefit later, which is at 1.8 million. But if the client doesn't care about the death benefit as much, you can have it stop earlier as well. So that's up
Got
to
it.
you. Yeah,
Okay.
you can design that
Got
whichever
it.
way you want that. But also remember, illustration is just showing the client this is what's possible based on what they're looking for. If the client chose to do this illustration to submit the application, but later on said, "Hey, you know what, Kat, I want to just stop the death benefit from going up," then they can turn off the option B to go back to option A. Or if the client didn't want to pay until 65, they wanted to only pay to 57, they can do that. Or if the client doesn't want to stop paying at 65, they want to pay until 75, then they can do that. So it's very flexible program. This is just showing a hypothetical scenario of what client is looking for, but they can change it at any time. All right?
So I know when I'm talking to my client, if he's asking these questions,
Yeah.
would I just call the company and tell them, or would he, or how does that work when you want to
Yeah.
change?
So if you want to do that, there is a form that the client can fill out, and they can change the death benefit option from A to B or B to A.
Okay.
Okay.
Is there, I know that some like products we have like the whatever test drive or whatever. Is there a way I can like do a dummy application, or do I just do like first name test, last name test and run it through up
Yeah.
until
Yeah. You can definitely do that. You can, yeah, it doesn't because like if you use a dummy one, it's not gonna really, it's not gonna hurt you're not using a real social or, a real client, so it wouldn't be a problem if you wanted to do that.
okay.
Mhm.
And you submit it on the application, or do you go to like the e-apps?
Uh, you go to, yeah, so here. You go to back to sales link, go to forms and material, online application. and yeah, click the life products.
I will give you a newbie tip for F&G that I wish I had known when I started
Mm,
writing with them.
yeah.
Just in the notes section, make sure that you put a note in there that you want the policy documents mailed directly to your client, because if not, they mail them to you and then you have to send them out.
Yeah. Yeah.
Oh,
So yeah,
okay.
you
Thank
can
you.
yeah, towards the end of the application, it says, do you want any special instructions? And you can put yes and say, please mail the policy directly to the client. Then you can do that. And if the client receives the policy, then client can go ahead and sign the policy delivery receipt and just they can actually, mail it back, or they can take a picture and send it to you as an agent, and you can also forward it to the delivery department and get that done. But that is necessary, yeah, to be done. F&G is a little more complicated with that. It just has more steps. And so if you're looking for an IUL and client is looking to only spend like 50 to $150 a month, and they are really looking for mortgage protection or affordable IUL, then I would stick with Mutual of Omaha IUL or Americo Instant Decision IUL, because the product is such a good price, and it was designed for more affordable for a large coverage that they get. Whereas the F&G, if the client is looking for overfunding it, or they're willing to put $500 or more, then I think F&G could be better for the client.
Okay, so what would be like a good, excuse me, what's like the amount that you would go from an Americo IUL to an F&G, like for a monthly premium? What, like
Yeah,
it's like
honestly,
200?
Dory, like it's hard to say like that because a couple of reasons. I really am basing it off of what the client is looking for.
Right.
So if a client is looking for, hey John, I want an affordable IUL. I want a large coverage for an affordable price, and cash value is good, but like I'm not trying to get rich off of that right now. So give me something that's permanent, give me some cash value, but a good protection. Then if we were to compare like the prices between America Mutual of Omaha and F&G, the F&G one is we can try to design a certain way, but if you just base it on target, it's going to be a lot more. It's about twice the America and Mutual of Omaha. So I would go towards America and Mutual of Omaha for the affordability plan. If a client is wanting to focus on cash value, and they want to overfund it and design it to where they only pay for 10, 20, or 30 years and stop paying into it and start receiving income, to do that illustration, then you'll have to go with F&G. So that's kind of where I would base it on, more than just the age or the coverage amount.
Okay, awesome.
Okay.
And for like to take money out, it's 10%, right, of the cash value before you hit a penalty?
No, that's for annuities. Yeah,
Okay.
that's for annuities. IUL actually does not do that. IUL client can take it out after a few years, without any penalty. Only thing is the client has an interest rate that they're paying back towards the company, the F&G company. But let's just say it's a 5% interest rate. Then let's just say client is getting around 7% average. So even the money that the client is borrowing, they can be still earning interest based on a non-direct loan recognition feature of the plan. So you're pretty much can borrow the money for free almost, right? If the market has been doing as good as that it has done over the last 20 years.
Okay.
Okay. So
Thank
there's
you.
no penalty to take out the money, Jory, but I would say this. I will show you this here. If you look at the year 10, let's just say this was his policy, then you see that surrender value. Client can take only up to 90% of this tax-free as a loan.
Okay.
So whatever the 90% of that, I think it's like gonna be like 80 something thousand. So that is the amount that he'll be able to take it out tax-free if he wants to do that. So
So if you
it's
were to
not
take
even
out more,
10%.
it would be not tax-free, the remainder?
No, it's not that. It can lapse the policy because at that point you're almost cashing out the
Oh,
policy. Yeah.
okay, okay, okay.
Yeah.
Gotcha.
And the how the wealthy and the smart people are using this is that when you take out, let's just say you took out 89,000 from this or whatever the 90% of this was, right? And at that point, you're still borrowing against your life insurance. So under the tax code 7702, you can actually borrow the money from life insurance, which is a loan, and loan is a debt, and debt cannot be taxed. So that's kind of the fundamental of how the IUL can be used as a tax-free income for the rest of their life. But if the client surrenders, there's a difference. Borrowing money, loaning out money from your IUL does not tax you. But if you were to surrender the policy, then there's a chance that you'll be subject to taxes because that means you're surrendering the policy and there is a gain from that. Okay. So that's why it's very important that we educate the client to where they're loaning against their life insurance policy, not just surrendering it. Okay.
Gotcha. Thank you.
Yeah. And plus, the client gets the critical illness rider, which covers heart attack, stroke, major organ transplant, aneurysm, tumor, significant burn, end-stage renal failure, cancer, terminal illness, chronic illness. If the client cannot do 2 out of 6 activities of daily living with a qualifying chronic illness, then the client can also get an income. So these are all added into the feature. So if a client is looking for like a one program that has all the different types of benefits for protection for his family in case he dies unexpectedly, if he gets an illness unexpectedly, it protects him. And if he doesn't die, if he doesn't get sick, then he still has the cash value that he can dip into as well. Okay?
Okay. And that over loan protection rider, just reading that, I've never seen that. What is
Yeah. So what it does is that it just prevents from the policy from lapsing due to the outstanding loan. It's just a nice feature because if the client wants to get a lifetime income, this is a great rider to prevent it from lapsing the policy. So
Oh,
even if the client took out all the money and now the outstanding loan exceeds the surrender value, policy is not going to cancel. And later, when the client passes away, whatever the death benefit minus the loan amount gets paid out to the family. So it's a nice feature on that plan. Okay. But Jory, in case client says, hey, and there might be an objection, and and this training is running a little longer, but I think this will be a good training. So let's just say client says, oh, but Jory, I put 120,000 and there's about only 103,000 and I can only take out 90 something thousand. So if the client has an objection like that, then what you can also do is you can go back and you can try to force the death benefit, not the death benefit, the death benefit to be lower and see where that gets you. So let's just say we were to force the face amount to be 800,000 and let's take a look. So let's see if it'll prevent us from doing that or if it's okay. So that way you can see since now there's less coverage, now there's less, oh, actually, let's make this option A. So let me take a look at this and we'll figure it out. So now this is closer to the 120,000, right? But let's just say we wanted to make this 700,000. Then you can kind of do it this way, Jory, and play with it and see a sweet spot where in 10 years he'll have just as much as money what he has put in there. You can also design it that way if you wanted to. Okay. So let's take a look at this and we'll wrap it up. Do you see now? It's almost there. So client will have more money in there, but also remember, more money goes to the cash value, but as an agent, even though client is paying 1,000 a month, you'll get paid commission based on the target APV, which is 8,386. Okay. So just letting you know.
okay. Thank
But
you.
yes, you can lower the death benefit to give more cash value to the client, but I also remember your client wanted to also have a high death benefit to make sure their family is okay in case he passed away. Million sounds like a lot, but with a $200,000 a year income, it's only 5 year income replacement. It's not a lot.
Yeah.
So yeah, this is a good example. This is a good illustration. But if he cares about the death benefit as much as the cash value, then I would do it the million way. If the client wants to have less death benefit and a little more cash value, then this is also a great option.
Okay. And if we do because right now it's set up for the B to A, if we were just to do the A and have the death benefit stay at 700K, the cash value would increase faster, correct?
Yes, it will. Yeah. So let's take a look at it. Yeah, most of the time it does. Some rare instances it doesn't, depending at the client's age and like how it's set up. But yes, usually A would because the death benefit is not going up as high. Oh, so it's mecking at 14, year 14. So there, do you see? So they're saying that for 700,000,
Yep.
just flat death benefit, mech is too low. So this is not a good illustration. That's why option B to A will be better because the death benefit is keep going up, it allows you to put more money in there.
Okay.
So for 700,000, I would do a B to A on that one. Okay?
Okay. So it sounds like I'm probably gonna end up playing with this a little bit with him to kind of fine tune it and find exactly what he wants.
But the thing is this, Dory, I wouldn't be showing client all the illustration software and do all that. It should be more like you have two illustrations. One is this, one is that. Which one do you prefer? Once you start opening that can of worm, it's endless. And you gotta take control and say, hey, based on my the my just trying to look for the best program for you and my research, this is the two best programs. Set it up this way or this way. One is focusing on more of the cash value. The other one is focusing on also more of the death benefit. So which one do you like better? Kind of go from there.
Okay.
Okay.
All
All
right.
right.
Thank you.
Yeah, can you guys hear me okay?
Yeah.
Yeah, so this is like the nuts and bolts, the training that you do. I wish we had this training more often
Hmm.
because setting up the policies are the nuts and bolts, especially when you really, really, really care and you're using your warm market.
Yeah.
Um, that's the integrity piece. That's the piece that goes so far, the trust. So
Yes.
setting up this, I just did one yesterday,
Uh-huh.
and I was thinking last night after I had done it, I said, maybe I should have solved because she was 34. I'm
Uh-huh.
wondering if I would should have solved for age 66 or longer.
Mhm.
And she didn't have a lot of money. So
Yeah.
maybe I should have done a move, but I wanted to give her all the options of an F&G, right?
Mm, I see.
So, but I was still trying to figure it out.
Mm.
But this is the nuts and bolts. Like this is the part that I'm signing on for.
Yeah. Yeah. I'm glad to
Learning
hear that.
these
Yeah.
structures. Yeah.
Yeah.
So you're the only one who's doing this. Maybe more can do
Yeah.
this.
Yeah, absolutely. Yeah, and that's why we do this. And if you have a particular scenario and you want me to do one for the future trainings to come, I'll be more than happy to do that. Okay?
Yeah. Where can we get the replay of this? Because I was having bad internet
Yeah,
problems.
I will. I'll get this posted on the YouTube channel, the Kim Agency YouTube channel, and I'll post it on the WhatsApp group as well, so you have the link to watch it. It takes about like an hour to just upload it, so I'll do that sometime today.
Okay.
All right?
Thank you.
Yeah, you're welcome. Any other questions before we wrap it up? Let's see. All right. Awesome. So yeah, and if you have some future like training topics that you want me to go over, let me know, and I'll try to go over those in the future trainings to come. All right.
All right.
Thanks,
Thanks so much.
guys. Yeah,
I really
yeah,
appreciate it. Now I feel a lot more confident going into this meeting tomorrow.
yeah. You're very welcome, man. And then I'll send you those example ones that I just did for you.
Okay.
to you so you can watch it. All right.
All right. Thank you.
All right, guys. Take care. Talk to you later. Bye bye.